The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Ben Boulos. These are your headlines. Global stock markets stage a rebound as traders look through fears over the impact of war in the Middle East. Tech and ship stocks lead the charge, with South Korea's Kospi on track for its best day in 18 years.
Well, crude prices resume gains amid continued concern over a potential prolonged closure of the Strait of Hormuz, even as US officials continue to pledge to support tankers moving through the region.
And that uncertainty looks set to weigh on European equities at the market open, with the Stoxx 50 called almost 1% lower. And China sets its lowest growth target in more than 3 decades as the country's leadership warns of risks to the economic outlook.
While recognizing our achievements, we're also clear-eyed about the difficulties and challenges we face. The evolving external environment is exerting a greater impact on China.
It's been the Asian market at the epicenter of some of the gigantic moves we've seen on markets in reaction to the Iran conflict, in particular the South Korean market. And that's where we kick off the coverage again, taking a look at fairly enormous moves, the largest spike in 18 years on the South Korean market. And don't forget, a day earlier, we were watching the worst trading session on record ever for that market. So the swings we've seen, we were down 7%, down 12%, and now the spike today up more than 9%. So it is somewhat like a yo-yo seeing the moves on that South Korean market. What is behind it? Well, again, there are a couple of factors here. Number one of the high flyers, very easy to liquidate some of those paper profits. Number two, one of the big importers of oil. So the market's been looking at that impact for the South Korean market. And of course, there is the EM switch, where investors are looking at the strength of the US dollar and simply pouring back on some of those very strong EM exposures. Across the rest of the region, other news flow too. Don't forget, we've got a new 5-year plan when it comes to the Chinese and the huge focus that they have on technology in particular. So it is that focus on leadership in tech that these companies will be chasing over the next few years. This is how it looks across the region. Now, part of that South Korean story was around the crunch around memory chip that has not gone away, the prioritizing of AI chips by some of these companies versus some of the other chips that go into devices. You've got Samsung Electronics up 11%. Again, but we've been watching double-digit moves for a couple of sessions in these particular names. SK Hynix up a similar amount, and you can see across the region we've also got a bounce. TSMC also firmer. To the US markets, well, some of those moves in technology stocks really starting at that US session yesterday. The ARK Innovation Fund, large moves there. FANG Plus stocks as well. The Nasdaq, as you can see, well and truly up beyond the moves on the Dow, 1.3% pop. We were off about 6% from the record highs before the session yesterday. We've narrowed that gap slightly, about 5% off the record highs, thanks to that gain you're witnessing. Well, to US tech up close, and you can see the extent of the gains. We did have the consumer discretionary sector up 2.2% yesterday. That was the top performing sector, but don't forget there are some tech stocks in that basket. But Nvidia itself up 1.6%. AMD moving 5.8% to the green. Tesla and Meta also showing some strength and contributing to those Nasdaq moves. To European futures, well, we saw a session yesterday where markets were clawing back losses from earlier in the week. We saw the German stock market up 1.75%, for instance. This morning, as we look to get going, you can see it's a split picture. So again, more cautious behavior expected on the continent. That's on the Stoxx 50 futures, it's on the DAX, but the FTSE, again, looking a little bit more resilient. And we circle back to the oil price and what we've got playing out on those spot prices. Now, WTI and Brent this morning, we are marching higher again, another 2 to 3% on both prices. And don't forget, yesterday we were talking about escorts through the Strait of Hormuz. The reality overnight is that the Navy have other priorities at this stage as we talk about the conflict and trying to take out Iranian targets. It may happen at some point. It's not happening just yet. So again, we look at the elevation in the price of oil. Gold prices, again, catching a bid. We're marking high by 0.8 plus. So the safety trade back on, Steve.
Okay, thanks, Karen. Hundreds of ships remain anchored both around the Straits of Hormuz on both sides, according to Reuters estimates, as the conflict in the Middle East effectively immobilizes shipping through the vital choke point. Since the war broke out on Sunday, at least 8 ships have been hit in the area. Speaking to our US colleagues, Treasury Secretary Scott Bessent outlined the administration's plan to secure shipping in the Gulf.
We began yesterday with the announcement that DFC will provide the insurance for both the crude carriers and the cargo ships operating in and around the Gulf over the weekend. Lloyd's of London nullified the insurance, so U.S. government is going to step in, and when it is appropriate and should it be needed, the U.S. Navy will provide safe passage through the straits for the oil tankers.
Israel said it targeted Iranian military facilities in the cities of Qom and Isfahan overnight, as well as Hezbollah targets across Beirut. Meanwhile, in Washington, Senate Republicans voted down a war powers resolution aimed at forcing the US President Donald Trump to pull back from the war in Iran. President Trump gave his take on how the war is proceeding.
Somebody said, on a scale of 10, where would you rate it? I said about a 15. And we're going to continue to do well. We have the greatest military in the world by far. Their leadership is just rapidly going. Everybody that seems to want to be a leader, they end up dead. And it's an amazing thing that's taking place before your eyes, because for 47 years we were pushed around and we shouldn't have been.
Right, let's move on to Aviva, taking a look at the numbers there. The headline figures are 25% increase in operating profit, operating earnings per share up 17%, total divvy up 10%. I think the stock is yielding over 6% anyway on this one as well. A couple of lines from the group. Aviva, according to the CEO, Amanda Blanc, delivered an outstanding performance in 2025, our 5th consecutive year of strong, profitable growth as well. One highlight that they're putting on the first page, they obviously want us to read it, is that they've achieved their targets 1 year early, according to the press release this morning. Let's get to the CEO. Dame Amanda Blanc is the Group Chief Executive of Aviva. Amanda, good morning to you. It's always that game, isn't it, where Karen and I and Ben get the numbers like about a second before we get to you, and we're trying to find the bits you don't want us to ask you.
But I mean, you know, you've had, minutes now? I mean, it's 7:07, so I mean, I'm expecting,
the Strait of Hormuz and trying to give you difficult questions. Tell us about the numbers as well. I think you've alluded to previously that you're going to hit your targets a year early. Just go through the situation as you see it.
Yes, so we announced in November that we were on track to hit our 2026 targets 1 year early, and we've done that. So, that's really good news. The operating profit up 25%. I think that's a really strong performance from the business. And, I won't repeat all the numbers that you've said there, Steve, but I think if we look at each of the business lines, they're all performing really well. So the general insurance business is growing by 18%, really good performance on the combined operating ratio, which is the metric we use in general insurance. Mm-hmm. But the wealth business is also really sort of firing on all cylinders, really. £11 billion increase in net flows. So, a really strong performance across the business.
I want to know about the next set of targets. If you've reached your 2026 targets or the 3-year targets a year early, I guess the markets going to want to hear about the next targets, and then they'll make a judgment on whether you're being ambitious enough.
Yeah, so we set new targets in November, and we'll obviously restate those today: an 11% EPS growth, a cash remittance target, and a greater than 20% return on equity. So these are really ambitious targets. 11% EPS, I think, is a really strong target, helped by the acquisition of Direct Line, but also the strong underlying performance of the business. So, we're very, very excited about that. One thing I didn't mention is the share buyback, which we've resumed today at £350 million. So, that with the 10% dividend uplift is a really strong shareholder performance as well.
Just a quick final one for me before Ben and Karen come in as well. I know how exacting you can be about getting the best performance out of your business as well. Where do you feel actually the biggest improvements could be made? Where okay, numbers are great, but actually where do you feel you just need to do a little bit more work?
So I think more work in Canada. So the Canadian performance is
the
good.
Commercial lines were down.
Yeah, commercial lines, we exited some underperforming portfolios, which is sort of standard for an insurance company. But I still think there's more work for us to do in Canada. We've increased the profitability this year, but we can do better there. I think the big opportunity is in the wealth space. The market is huge, and we have got 4.5 million workplace pension customers. So, we have a really exciting opportunity to take advantage of the regulatory tailwinds that are coming there with targeted support. So, that's it, the aim to help those, 18 million people in the UK who are not able to take any advice or do not feel advice is for them. And this is an opportunity for Aviva to be able to help them.
Can I get into the insurance lines? I can see insurance premiums up 27%. We were talking to a reinsurer the other day, and the message that came through was that perhaps property is cooling to an extent, but casualty very strong still when it comes to pricing on premiums. What would you say about what you're saying? Does that reflect a very similar story?
So some of our growth is down to the acquisitions that we've done. So we have 2 acquisitions coming into the numbers, Direct Line and the Probitas acquisition, which was the Lloyd's business that we bought a year and a half ago. But I think every product line is performing slightly different, Karen. So you've got, the commercial motor where you're seeing good rate increases, commercial property maybe not so much. But for Aviva, because we're a big UK, home player, the SME business for us is really strong, and we are still seeing some smaller rating increases there. So it's really difficult to look at it. You have to look at it line by line. But I think the benefit of being a scale player, 22 million customers in the UK, is that you can actually allocate your capital according to the different lines where you believe you can make the better return.
Well, let me flip that around, because when you're a scale player, you also get more impacted by the macro. And we are now talking about events in the Middle East that may have consequences for the global economy. If we see oil prices sustained at a higher rate, whether that starts to shave numbers off the growth rate, whether we see inflation come back into the mix, how are you thinking about the fast-moving pieces in the Middle East so far?
Yeah, so look, I've been the CEO of Aviva for the last 6 years, and we have seen various things happen, starting with COVID, then moving into the supply chain shocks following the Ukraine war. So I think that as an insurer, we are more than used to seeing these supply chain shocks and how that comes through. So for us, for example, in the repair of vehicles, how do we make sure that we've got the parts to be able to do that? So it's about being ahead of this and pricing ahead of that. If you can see that there's an inflation shock coming, then don't wait for that to happen. You start to price for that. Well, it's hard to say. I think we're still only 5 days into this situation, but I think that all of the teams are constantly looking at the data, and we have the benefit of lots of data to be able to see, are we seeing things coming through in the data, which means we need to react.
Amanda, we speak a lot about the impact of artificial intelligence on the programme, and I just wonder, as a big insurance company, if I were running a business about to integrate AI into my operations, I'd be thinking, well, what if it goes wrong? I need some cover. I just wonder how much of a growth opportunity you see there. Do you have products already available that will insure against losses or a fallout from AI going wrong?
Well, first of all, I think that let's think about the opportunity with artificial intelligence. For Aviva, we have been using artificial intelligence for a decade. So 98% of our personal lines products are underwritten today using machine learning. So, I think when we hear all of the noise around technology, we're sort of saying, okay, yes, generative AI is the next step, but we've been using it for the last 10 years. And if I think about, the way that we are approaching this, it's about our 22 million customers, the proprietary data sets that we have, all of the claims data, all of the underwriting data, all of the customer data, spread across all of those different product lines. For us, we see this as a real opportunity. How do we personalize our propositions to our customers with the proprietary data sets that we have? So the technology is one thing, but actually the application of that technology, that's a completely different thing. And you have to have customers, you have to have data, and you have to have the ability to pull all of that together. So we feel confident about that.
So if you're confident on that front, just to get your take on the current UK economic picture, we had the spring statement yesterday. How do you feel the economic, the business environment is for an organisation like yours and others at the moment?
Yeah, so I mean, if you look at the spring statement numbers, obviously you saw the reduction in the growth outlook and the increase in the unemployment, which are two, not great metrics. But if we look at it as Aviva, we're a big investor in the UK. We invest over £100 billion in the UK, 40 billion of annuity pension holders. So for us, we think that the positive messages around growth, around infrastructure, those are all good things. I think it's like, I think I've said this before, it's like looking at a jigsaw. You can see the outer bits. What you can't see is what the picture's going to look like when it's all complete. So we would just urge the government to sort of pull all of that together so that we can continue to invest in the UK, to make it easy for us to invest, our own money and our policyholder money for the benefit of the UK and the benefit of our policyholders.
Amanda, you have an immensely powerful position. And when you met the Chancellor at the end of January, I don't know if you've met her since, but I know you met her at the end of January. Did you explain to her the error of her ways and how she's not encouraging people to save and how they're not encouraging people to put money by for their pensions? In fact, they're making it much worse because of their changes to commitments and salary sacrifice as well. I'm sure you, being a very forthright person, told Rachel Reeves that she's very wrong.
So look, I think from a salary sacrifice perspective, we are disappointed with the measures that were taken on that. If we look at the UK today, 12.5 million people are not saving enough money into their pension. Therefore, why would you put something in place which sort of makes it more difficult for them to do that? So I understand that, the economics are difficult, but I genuinely feel that we need to be encouraging people to save more. And there is a lot of positive, initiatives. If you think about the retail investment initiatives, those are all positive initiatives coming through from the government. But I think this point on salary sacrifice for us, and you've seen the Association of British Insurers have written in the last 48 hours to say we really would urge that you really think about this, because discouraging people to invest in their pensions is not a good idea.
And do you think it's going to fall on deaf ears, or did Rachel Reeves actually say, yes, you're right, Amanda?
Well, look, Steve, one thing that I will tell you is that I will just keep saying what I believe is right for our customers and for Aviva. And I genuinely believe that for customers, this is not a good idea. So we'll just keep saying that. And, I am pretty relentless, so I'll just keep saying it and see what happens.
OK, well, let's hope the politicians listen. Really nice to see you, and we do appreciate you coming. I know you've got a stunningly busy day, so thank you very much for coming in. And you brought your two henchmen with you as well. I don't want to mess with those two. They only put on a suit for this day. Amanda Blunt, thank you very much indeed. Group Chief Executive Officer over at Aviva.
Plenty more still to come on the show, including this. China sets its lowest growth target since 1991. Elaine will bring us the latest live from Beijing. Plus, we'll dive into the OECD's global debt report as it says states and corporations are set to borrow nearly $30 trillion this year. And the spat between Spain and the US continues, with Madrid rejecting suggestions from the White House that it's agreed to cooperate with the American military. Arantxa González, former Minister of Foreign Affairs of the European Union and Cooperation of Spain, joins us this hour.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone at CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Governments and corporations are expected to borrow nearly $30 trillion from markets this year, 17% more than in 2024. That's according to the OECD, which has warned that even though debt markets remained resilient in 2025, they are being transformed by shifts in the investor base, creating risks that need to be managed to ensure markets can continue to provide stable financing. Matthias Cormann joins us now, Secretary General of the OECD. Matthias, thank you so much for joining us. We do appreciate your time. It's a wide-ranging report, and it tells one tale of resilience, despite the fact there's been so many complications in the global economy, from tensions, geopolitics to tariffs. Just explain what you're witnessing in terms of the borrowing requirements going up and why markets are simply just defying gravity.
Well, the financing needs are certainly going up and up and up. And one big factor is the increasing investment needs around the AI-related transformation. What we are seeing is, though, a move away from longer-term maturities towards shorter-term maturities, and indeed, as you've just said, a change in the investor base towards a more price-sensitive investor base, which I guess makes the outlook in terms of the financing moving forward a bit more risky.
What's been a feature of the markets of late has been the dominance of borrowing by sovereigns. But interestingly, we've also got the hyperscalers coming into the market, and the numbers, $122 billion in bonds raised in 2025. Does that change the dynamics? Because it feels we're just on the cusp of some of these borrowing requirements as we build out an AI future.
Well, borrowing requirements are going up very significantly, and it's certainly the case that the investment requirements will not be able to be met either by public financing or by bank lending. So equity markets and bond markets will have a very important and significant and growing role. But what we do see is that central banks have been reducing their investments in bonds, and as that has happened, we've seen hedge funds, households, and foreign investors move in. But also really with that trend towards shorter maturities away from the longer term maturities, and all of that combines to create an increased level of risk.
Hey, Matthias, good to see you. Very often pictures can be far better than 1,000 words. The picture at the top of your report is somebody on a very shaky temporary ladder over a crevice, from what I can see. Is that how you see us at the moment, actually, that we are on very shaky ground?
Well, look, self-evidently, there is a lot of risk, in the global economy at the moment. We've seen 2025 increased level of policy risk, increased level of policy uncertainty, combined with elevated levels of borrowing. The debt repayments, as a share of GDP, are close to their peak over the last decade, and indeed the trend is on the up and up and up, and so in terms of debt sustainability, in terms of a focus on fiscal management, on structural reforms to drive growth, and getting some of the downside risks off our table, there certainly is a lot going on in the world right now.
Let's go back to this hyperscaler point that you and Karen just mentioned earlier on as well. I know you don't look at the profit side of things and you don't look at the revenue side of things, but how concerned should we be given past technological revolutions, i.e. the collective shock that we got in 2000, 2001 when the dot-com bubble burst? I'm not calling that the AI bubble will burst, but I just think, should we be very, very concerned about those levels of debts compared with revenues?
Well, look, the upside potential, the upside opportunities, and the opportunity for returns related to the AI transformation are obviously very significant, but it is also true that, markets are, there's a level of uncertainty. There's high levels of expectations, but, it's not yet possible to precisely quantify with any degree of certainty, how that ultimately is going to translate. And I think that's people are, betting on certain outcomes without necessarily, having all of the information to make fully informed decisions. And that is, I guess, what we see playing out.
But Matthias, I guess the OECD is looking at this holistically. Have you found these thousands and millions of jobs that are going to be created by AI yet? Because our guests on this channel, apart from a few people overseeing the AI models, have failed ignominiously to do so. Is the OECD terrified about the amount of job losses that's going to happen on the back of this?
No. Well, our expectation is that certainly that this will transform labour markets. There will be jobs that will disappear, and there are new jobs that will be created. But overall, it's going to. Our expectation is that this will be a positive. Many of the jobs that will disappear will be replaced by better jobs, and so in any event, this is an inevitable innovation train that is underway. I mean, so we need to focus on making it work in the best possible way to support people through that transition, through that transformation, to make sure that people have the best possible opportunity to participate and benefit from it. But, I mean, there's no question that there will be a very substantial and structural transformation of labour markets as a result.
I just want to return. It's Ben here, Matthias. I just want to return to the sovereign debt issue, because there seems to be no sign of governments reining in their spending significantly. The US deficit is looking like it may even widen. And given the already high levels of debt, and we saw the yield on treasuries and bonds rise this week, but, giving an insight into investors' fear about inflation. And then we have the pressure on the Fed to cut rates from President Trump. I just wonder, with all of that in mind, are the factors of a storm building in terms of the sustainability of those very high and increasing levels of sovereign debt?
Well, I mean, indeed. I mean, these are the very significant pressures that we're warning about. I mean, fiscal sustainability, sound debt management, making sure that there is a credible trajectory, or a credible strategy to manage debt sustainably, but also to pursue structural reforms to boost growth, which of course is also an important element when it comes to debt sustainability. But I mean, all of the pressures that you're mentioning are there. I mean, clearly those the factors that are driving bond yields, I mean, are factors related to fiscal and the monetary policy outlook, and to the extent that there is elevated inflation also in the sort of current evolving context, and then that will put upward pressure on monetary policy, if anything. And so, I mean, all of these factors that you mentioned are indeed important risk factors that we point to in our report.
Very good to see you today, and thank you very much indeed for bringing us such a timely report, Matthias, as ever. Really good to see you, and we hope to see you again soon. Matthias Cormann, who is the Secretary General of the OECD. A lot of rhetoric between the Iranian leadership and the US Central Command about whether the Strait of Hormuz is open or shut. It's not as simplistic as saying that the US military, the US naval forces can escort tankers through, because as has been done historically previously, if Iran were to mine the Strait of Hormuz, which is, bear in mind, at its narrowest point, only 24 miles wide, very difficult for the US to guarantee that those mines will be swept ahead of any traffic going through, given the vast amount of traffic that normally goes through this global choke point, which we're all learning so much about. So it is a very difficult situation. The Iranian Revolutionary Guard now, the IRGC, is saying in time of war passage through Strait of Hormuz will be in the hands of the Islamic Republic, according to state media. So rather than backing down on this very key issue as well, Iran is doubling down, saying actually they control the passage through that as well. And again, it's not as simple as whether the gunboats go out or the Iranian ballistic forces or missiles could be attacking traffic. It's also about the fact that there are fears about mining of that route.